morning and welcome. I'm Kevin Steinberg, the Chief Operating Officer of the World Economic Forum USA, and it's a pleasure to be here with this distinguished panel this morning. Today we're going to focus on the myths and realities of private equity. And this is part of a longer series taking place within the World Economic Forum's annual meeting this week, focusing on the changing nature of the financial markets, focusing on a number of players that are increasingly important with respect to the capital markets themselves. I'm joined today by a very distinguished panel. I'll introduce them and we'll ask them in a few moments to make some introductory comments. Beginning to my right is Don Gogel, the President and CEO of Clayton, Dubilier and Rice. We have Martin Halusa, the CEO of Apax Partners. Anatol Koletsky, an editor-at-large of The Times in the UK. Josh Lerner, Professor of Finance, Entrepreneurial, and Service Management at Harvard Business School. And David Rubenstein, the Founder and Managing Director of the Carlyle Group. The impetus for today's discussion really is the tremendous growth in private equity over the past several years. In some research that we'll talk about in a moment, one can see the incredible growth over past years, with transaction volume in terms of deal value growing tremendously and reaching $2.7 trillion if you look at the period of 2001 through 2007. Not only has there been tremendous growth in terms of the deal value, but there's been tremendous growth in terms of the scope of the transactions, in terms of the reach of number of the firms that are represented here and some others that are leading the market. And as a consequence, there's been a real discussion in the public arena with respect to the role of private equity firms and with respect to how they can interact with a great number of constituencies. Therefore, the World Economic Forum roughly a year ago commissioned some research which was to focus not only on the globalization of alternative investments, but really to focus on the increasing global economic impact of private equity. Just yesterday, and I think we have a slide we'll put up in a moment, we released a report which was conducted and really researched through a core academic team led by Josh Lerner, and we have in the audience with us today a number of his colleagues who worked on it. And this set of working papers, we hope will really serve as the basis, not for this discussion in particular, although we'll allude to it in a moment, but really to elevate the level of dialogue that's taking place based on a very rich fact base, based on hopefully the beginning of an interactive conversation which will begin today in this room, but extend beyond not only within the World Economic Forum, but in the public arena more broadly. In terms of our agenda for this morning, what we thought we would do is ask Josh first to start us off by sharing very high level some of the findings from this research. And then we would ask each of the panelists to share some opening remarks and thoughts very broadly on private equity and some of the trends that we've been then discussing. I'll have the pleasure of moderating discussion between the individuals here on stage, and then we'll save the last 40 minutes of our time in order to have Q&A from the audience. We very much hope that all of you will participate and share your thoughts and ideas. In the spirit of Davos, we hope this will be an exchange of views which may not be all exactly in line, but we hope will enrich the debate. And we very much are happy to have all of you here with us today. I'll turn then to start us off to Josh Lerner, who ably led the research team that put together this work. And Josh, we hope you could spend a few minutes just sharing some of the high-level findings.
Great.
Josh.
Well, thank you so much, Kevin. So, as Kevin alluded to, our motivation here was really driven by the discussion, the ongoing policy discussion around private equity that we've seen in the last 2 years. In particular, what challenged us or troubled us was that while there was clearly intense interest in private equity, and while there was strong claims made both by friends as well as critics of the industry, in terms of the fact base to really go back and look at, it was very limited. And in particular, there had been a surge of academic research during the 1980s and early 1990s, which had looked at the very early wave of buyouts and had come up with some findings and some generalizations about what was taking place. But we knew that the industry had changed and evolved very dramatically over the last 2 decades, and yet the academic research had not kept up. So that while policymakers, while labor leaders, while industry leaders were very interested in all these questions, our ability as academics to really answer it and provide the evidence was really almost non-existent. So we approached this by putting together with collaboration with a number of people who are here, including Francesca Corneli, Per Stromberg, and Christian Achleitner, we put together a research agenda that looked at a variety of different aspects of the industry. Some through 4 large sample studies looking at different aspects of private equity and how it impacted the economy, as well as through half a dozen case studies. I'm gonna, if we had lots of time, I would sort of walk through all the results and discuss them. What instead I wanted to do is just highlight a couple of the studies and a couple of the findings we had from them. One of the studies that Per led looked at the demography of private equity firms. In other words, asking the question of what is really happening in terms of private equity-backed firms, what happens to them before the deals, how long do they stay backed by private equity, what happens to them afterwards. And in that study, really 2 surprises, at least to me, came out. The first had to do with holding periods. Our anticipation going in, or at least my anticipation going in, was that we would have seen that holding periods of firms by private equity groups had actually gotten shorter in recent years. We read all this stuff about quick flips and so forth. When we actually looked at what we saw in the evidence from looking over 20,000 transactions over the last 3 decades, is we saw exactly the opposite, which is to say that the time that companies are remaining held by private equity groups, whether we look at simply an individual company being held by one group or look at a company which the entire period that the company remains owned by private equity, actually has lengthened rather than shortened. Similarly, a surprise that came out of that study had to do with bankruptcy. And again, when we sort of think about it, we say, well, it must be a fairly common outcome that either a bankruptcy or a major restructuring of corporate debt as part of private equity transactions. When Per actually pushed the numbers and sort of looked into the details, the results again were quite surprising, at least based on what I thought we were going to find, which is that essentially the bankruptcy rate per year, so the probability that a private equity-backed company goes into financial distress in a given year, is on the order of 1.2% a year. And to just contrast that with one other rate, if you look in the United States at corporate bond issuers of all types, the rate is around 1.6% a year. So again, it was surprising and a little bit against the expectations. Similarly, there were a number of surprises in the study we did on employment. In particular, we looked at companies back in the United States which got private equity transactions using the very detailed census data. We essentially followed around 5,000 companies, and we actually looked down to the level of the individual factories, so around 300,000 separate factories and offices owned by private equity-backed companies, and compared them to the roughly 6 million or so other companies and other factories out there in the United States. And what we found was really three patterns. First of all, we found that the private equity-backed firms, the private equity-backed, the companies which received private equity in the couple of years before the transaction were already losing jobs relative to their peers, or growing more slowly than their peers. Roughly, the difference between the private equity-backed firms and the other firms was around 4% over the two years beforehand. They created 4% fewer jobs. That pattern continued in the 2 years afterwards. So essentially, in the couple of years afterwards, the firms owned, the factories and other establishments owned by the private equity groups actually created 7% fewer jobs than the comparable matching firms or matching factories with the same age. However, it gets more complicated because at the same time, these same private equity-backed firms were also more active in creating new jobs by opening new factories and other facilities. And in fact, this rate of greenfield job creation, or job creation through opening new plants, which was around 6% in the 2 years after the private equity transaction, seemed to largely offset the job losses at the existing facilities. By the end of the third year, there was no real differences between the private equity groups, backed firms, and the other other firms in terms of job creation, that this was a sort of short-run period. But during that short-run period, you seem to see both job creation and job destruction, a real period of very dramatic change. So, well, we certainly did a variety of other analyses, and the analyses we did had a number of other interesting results. I think that's enough to sort of get us started, I hope.
Great.
Thanks.
Thank you, Josh. Indeed, that's a great start, and I'm sure we'll come back to some of those in a few moments. To set the stage a little bit more, I thought perhaps I could ask you, Don, if you could comment just more generally on not only the rise of private equity, but the general shift from the public markets as a vehicle to fund corporations to the private markets, and how private equity firms have played a critical role in terms of that shift.
One of the longest standing debates that I have with friends who are CEOs of major global companies are, why is it that private equity should have any advantage whatsoever over a public company? After all, the public companies have benefits of, they claim, access to capital in most markets. They have much more visibility. They have been sort of long-standing corporate citizens. So why should a private equity firm be able to pick up either a division or in some cases an entire company and end up with some better performance? The theory of the case actually is quite simple, and that is that private equity has a number of structural advantages based on its essence, which is as a transitional form of ownership that allows a unique and intense level of focus on a handful of variables that most chief executives would say, yeah, that's what I do, but I don't get to spend enough of my time on it. I think the secret of the private equity industry is this intense level of focus really on a handful of key issues. It starts with an expectation of change. Private equity typically gets involved in businesses that need and expect to change if they're going to thrive. One of the interesting side notes to the academic study is that the typical private equity target is a business that is losing, compared to its peers in its industry, employment in relative terms. That means it's growing more slowly if it's a service or retail business, or it means it's shedding jobs slightly more than a business that is not going through the buyout. Well, it's in that context that everyone in the buyout firm in the target says, well, things have got to change. So we start with this benefit of expectation of change. And indeed, that is exactly what happens. Under new ownership, there's the ability to attract world-class management who are excited about having the opportunity to make these changes. We have the benefit of setting in place new compensation systems that are not tied to other divisions or other parts of the company, or in fact legacy systems. It's a fresh start. I think we have the advantage, of course, of using leverage prudently. A AAA or a AA bond rating has not necessarily led to superior returns for major corporations. It clearly provides a level of safety in difficult times, but as you can see from the not failing but the slippage of many AAA and AA companies in terms of their stock price, it's no guarantee for long-term success. I think another key advantage to private equity over the years has been we are able to be selective. We don't have to invest in every year. Clayton, Dubilier, and Rice went through 3 full years in the 1990s where we didn't have a new investment. Remember, the private equity industry doesn't have cash on hand. We have forward commitments from loyal institutional partners who are just as happy when the market is not right to make investments to let us sit and wait for the right time. So those are a handful of advantages that truthfully are not likely to change over the short, medium, or even long term, at least as I see it. So even though we're going to go through a period of lesser deal making, driven by and large both by the liquidity cycle, which is diminished, and some recessionary pressures, those structural advantages are likely to endure.
Thank you. Well, in light of some of these advantages, in light of some of these changes, nonetheless, we've had the question posed to us quite frequently, why does the industry have such a bad reputation? Why is it that it's been occasionally singled out for criticism either in the press or elsewhere? Perhaps, Martin, you could let us know your thoughts in terms of why the industry has faced that challenge and whether the industry should be doing in terms of, what the industry should be doing in terms of responding to some of those concerns.
I think there are really two reasons why there's been quite a bit of bad reputation around the industry lately. And one is that I don't think it applies only to private equity. I think it is private equity, hedge funds, sovereign wealth funds, they're all thrown into the same pot. And particularly in Europe, I think the background to that is a certain malaise in general about Anglo-Saxon type capitalism and the perceived view that this capitalism only has shareholder value as its single focus and does not buy into the traditional, at least in Europe, social consensus around how businesses are run. That it is something that is very global in nature, so it does not have a lot of roots in the local community. This is money that can come from any part of the world and is collected in funds and invested in certain countries, so there's a sense of not much responsibility to the local community. And I think these fears are general, and private equity has really worked as a lightning rod over the last 2 years, where it is expressed more. And I think the second reason is that we as an industry have flown under the radar of media attention for the last 20 years. And the deals that we did were small, relatively small. They weren't typically public companies. And so the interest in what we did was pretty low. And only since we've been able to raise very large funds and start buying and investing in very large public companies, where, again, in Europe, a lot of people think that they have a sense of ownership, a public ownership of these public companies and have a right to know what's going on there, that we came into the limelight. And once we were noticed, then this malaise was applied. And I think the mistake that we have made is that we have, for a very long time, not really engaged with the media, not explained what we do. And I think it's high time that we become much more transparent and explain exactly what this process is, as Dan just did.
Thank you. Well, Martin, you mentioned that the industry has flown under the radar to date, that things are changing and that there may be changes that are expected going forward. Perhaps I could turn to Anatol, who could share some thoughts not only on why things have changed so dramatically, but what are some of the expectations from the public going forward? Or what are some of the constituencies that this group really should be focused on in light of some of these changes?
Well, I think, as Martin said, clearly more information, more transparency is something that is going to happen. And I think, again, as he said, it's really to do with the size, the scale of the acquisitions and the prominence of the target companies. Once you get above a certain level, then naturally there is a public demand for information. And of course, especially if you've been taking public companies that have been under a great deal of scrutiny, in many cases, in fact, as Don said, these were struggling companies. These were companies that were not doing too well. There is going to be a natural focus on what happens to those companies afterwards. Again, as Don said, it's in the very nature of the private equity business to accelerate change, and in many cases these changes have already been happening. These companies have been in decline. If you accelerate that decline, even if it's followed by a period of renaissance, as we've heard from the study 2 or 3 years later, there is going to be a lot of public attention to that. So I think that's one of the issues. But I think there is another set of issues, which is that the growth of the public equity, of the private equity business, I think, has not just been based on, if you like, the kind of management arbitrage that Don has been talking about, the superior management, the greater willingness to take tough decisions, but there have been a couple of other forms of arbitrage, at least in some countries. Tax arbitrage, the treatment of carried interest in particular in the UK tax system, but I think also in the US tax system, has understandably generated some controversy, and we may want to discuss later on whether that controversy is justified, but a lot of people have got very rich and paid relatively low marginal tax rates. And I think the third arbitrage, apart from management tax arbitrage, is a kind of financial arbitrage, in that one of the reasons that private equity has grown so much in the last few years has been, in my view at least, a bias against equity and in favor of debt in the public markets due to all kinds of macroeconomic reasons that one could talk about. And that has led to a perception that a lot of companies are being bought too cheaply, and I think objectively they were being bought too cheaply. That's exactly why the private equity business was doing well. Now, it's not your fault that the markets were pricing these companies too cheaply, but there is a sense, even among your own investors, your own limited partners in the pension fund community, that somehow you were stealing their assets from under their noses, which in a sense you were. It was their fault for giving them away, but there was that market anomaly, which perhaps is being corrected now because of the price of debt going up so much.
David, perhaps I'll turn it back to you. We've raised a number of questions about whether this controversy is justified, in particular the notion that pricing was done too cheaply.
Okay.
I guess, would you care to comment on some of those aspects?
Okay. First, I'm just curious what propelled people to get up so early on a Saturday morning to come listen to private equity. How many people here are general partners in firms? How many are limited partners? How many are service providers? How many are government officials? Any press? How many people are lost? The great thing about this Davos, as we get close to the end, is that for the first time in about 5 years, we haven't been the object of as much attention or scorn as we have in previous years. The sovereign wealth funds have gotten most of that this year, and so I am very happy to be put on the sidelines a bit because we haven't received as much criticism as we used to. In fact, now I'm a little concerned that we're not getting enough criticism because it's all going to the sovereign wealth funds. But I do think that the private equity people have, over the last few years, learned a few lessons, and I think the sovereign wealth funds are going to follow our example a bit, are trying to be much more open about what we do. We did receive probably appropriate criticism for not being as transparent as maybe we should have been, not being as open about our techniques, and probably didn't engage with the constituencies of the economy as much as we did. We used to just talk to our investors, tell them how great our rates of return were, they gave us more money, and we went about our business. Now we recognize we need to deal with communities, labor unions, environmental groups, consumer groups, and the public at large and the press to explain what we do. I think the private equity industry has grown so large because we have provided a very good service for the investors. The investors are not giving us money because we're so charming or so handsome. That's obvious from look at some of the general partners here. It's obvious we're getting money because we're giving spectacular rates of return, and people are driving right now to get high rates of return, and we've been delivering it fairly consistently over 5, 10, 15 years. People recognize that if you're in a top quartile buyout fund, you're more likely to get a higher rate of return than almost anything you can legally do with your money. And it's been fairly proven over the last number of years. So that's why the industry has grown a lot. People have, in this Davos, been asking me, well, aren't you guys going to be out of business now? You can't get large leverage. You're not going to be able to do these $20 and $30 billion buyouts. Almost people are sympathetic to us, it seems, not quite, but a little bit. The truth is you don't need to shed any tears for the private equity firms, I think. We actually have transformed ourselves over the last 3 or 4 years into firms that are not really that dependent on leverage to do large buyouts. Most of the large private equity firms now are multi-product organizations. They are doing non-levered transactions, minority stake transactions. They're doing things in other areas, real estate or venture capital, and they have diversified, and all particularly diversified out of their core country. Most of the large private equity firms are now investing around the world, particularly in the emerging markets. And in many of these emerging markets, you don't tend to need leverage that much, and probably more money will be poured into the emerging markets over the next 3 or 4 years by the large private equity firms than in their own core market. So I think there's a transformation going on in private equity now, and I think it's a healthy transformation as the private equity firms diversify away from some of the things they've done in the past, but they also retain their expertise to do some of the large buyouts, and those buyouts will come back in time. I think while it's difficult to do a $10 and $20 billion buyout today, it's not that difficult to work on the companies we already own that are in that category. And I think you'll see a lot of the private equity firms spending a lot of time improving the companies they already own. Enormous numbers of deals were done over the last couple of years, and the greatest opportunity that private equity firms have to make money over the next couple of years is not by doing new deals, but by fixing and improving the very good companies that they already have, or the companies that aren't yet as good as they want them to be. And that is probably where we can show a fair amount of expertise. We do get criticized a fair bit. If we make too much money, we get criticized, and then we get criticized if our deals don't work out. It seems as if there's an amount of profit that seems to be acceptable, and it's not quite clear what it is. But if we make too much money, we are roasted for stealing companies and stealing from the public. And if we don't make enough money, people say, well, we're not really as good as we say we were. So I'm not quite sure what the right balance is. I do think that private equity firms probably suffer a bit from the sense that if you're making too much money, you're doing something wrong. Balzac, the famous French writer, said, behind every great fortune, there's a crime. And to some extent, that may be a bit of a European attitude. If you're making too much money, something must be done that's wrong. I don't think that's fair or accurate, but I do think that sometimes when we do make a lot of money, people think we've done something improper. All we've really done is try to improve the companies that we've bought and use techniques that really have been used for many, many years. They've just been getting more visibility now because there's more press focused on private equity, and the deals have been a little bit larger than they've been in the past.
Great, thank you. Well, you alluded to the diversification of many of the private equity firms into overseas markets. And I guess perhaps I thought I'd turn to Josh. I know one of the trends that came out of the research and some of the case studies was the increasing globalization of the industry. So if you could care to comment on some of those trends, I think it would be welcome, particularly to a number of the folks here in the audience who are coming from emerging markets and wondering how this will take root with respect to transactions of companies in their respective countries.
Absolutely. So certainly when we look at the birth of a private equity business, this really was a very U.S. and Western European centered activity. And that was certainly true for not just the 80s and 90s, but it really wasn't until this decade that we saw the real growth in terms of private equity elsewhere. What we've seen, particularly in the last 3 to 5 years, has been this transformation or this mutation of the private equity model into a wide variety of developing countries, to the point that if you look over the deals done during the decade of the 2000s, on the order of 12% of the private equity deals by number and 9% by dollar volume were done outside of the core U.S. Western European markets. But it's important to emphasize that even though private equity is becoming more important, not just in China and India, which have gotten lots of the attention, but in Eastern Europe and in many other places, private equity is changing and evolving to adapt to these different markets. And in particular, we see the kinds of deal structures being used, the kinds of roles that the groups are playing in terms of originating and working with the portfolio companies. This was very much highlighted in some of the case studies we did in the course of the study, and I think you also see it more generally that yes, private equity is moving into these areas, but yes, it's also changing in terms of how the deal. So, for instance, typically it's not the major big leverage buyouts, but it's much more deals that have a spirit of growth equity or minority stakes and really working with and bringing the companies along in a way that is quite different from the sort of classic large leveraged buyout as it's been practiced in the United States, for instance.
And, let me just say that the term emerging market is a little bit of a misnomer. It applies to virtually every country in the world except for Western European countries, Canada, Australia, Japan, the United States. So roughly 200 countries are so-called emerging. If that term had been used by somebody in so-called emerging markets to talked about the other countries, we might be called now submerging countries because it seems our economies are a bit going down. It's really unfair to call China and India emerging in the same sense that Chad or Mozambique are emerging. And we really need a better word to describe what these large countries are that are really going to dominate the world's economic scene in the future. They're not really quite emerging as much as maybe they were 20 or 30 years ago when that term first came up. You're going to see two things that I will mention about in the emerging markets, in addition to what I said before. You're going to see a lot of, as I said before, a lot of the Western private equity firms going into the emerging markets and investing there and putting as much money there as we have elsewhere. In our case, I think we invest as much overseas in emerging markets now as we do in developed markets. But the two trends that I think people might think about are that the sovereign wealth funds, which tend to be in these so-called emerging market countries, are probably going to be gigantic investors at some point in their own countries and their own regions, because they have enormous amount of capital, and they're not just going to provide it to the West or to the developed markets. They're going to do it in their own countries as well, in their own regions. And secondly, right now you see that the dominant private equity firms in the world tend to be American, and with a few that are based in the UK. Amazingly, the global private equity firms, none are based in the continent of Europe, and none are based anywhere in the so-called emerging markets. That will change. The sovereign wealth funds or other large sources of capital in the emerging markets will probably set up emerging market-based private equity firms that will be designed to be global, just the way that the American ones are. It's not unlikely that you can have so much wealth in the world in the emerging markets and not have dominant global private equity firms that are based in those markets investing there, as well as investing in the West or the submerging markets.
Can I just ask David a following question? Do you think that the sort of competition is going to come in the form of the sovereign wealth funds themselves directing their own funds, or from other intermediaries that they're backing and setting up?
Because of the attention that the sovereign wealth funds have, and because they're now beginning to get very sophisticated advisors, what those advisors will tell them is, because you're a government-owned entity, you're going to have some problems in buying certain companies in the United States or in Western Europe. So why don't you do this? Why don't you find somebody that's worked at Blackstone, Carlyle, TPG, who might be from your country, grown up in your country, educated perhaps in the States, worked at Carlyle, Blackstone, TPG, KKR, other very good firms, Clayton, Dubilier, or Apax, or others, and they will recruit those people, perhaps, and say, we'll give you, if you start a private equity firm based in Beijing, we'll give you $2 or $3 billion as initial capital. We won't own any of you, but we'll be your biggest limited partner. And by being your biggest limited partner, you'll probably listen to us a bit, but we won't be technically you won't technically be a sovereign wealth fund. It just strikes me that it's unlikely you're going to continue to be able to see so much capital from those parts of the world going to the Western firms and then reinvesting in their country. In other words, how much longer will it be before Chinese investors say, why should we give an American firm money to invest back in China and let them charge a 20% carried interest? What we should do is set up our own firms based in our own countries, give them a large amount of money, and let them become global firms investing around the world. I'm not advocating that this should happen. Obviously, it wouldn't be my self-interest, but I do think it's inevitable as people begin to see what's going to happen. So to answer your question, I don't think they'll do it through the sovereign wealth fund necessarily. I think they'll help set up organizations and be their largest investors.
Could I just make an observation of that? I think this is a very interesting issue, but there is a macro, I'm more of a macroeconomist, and there is a macro reason why I think actually things may turn out more favorably than that from the point of view of the Western private equity industry, in that if you think about it, the reason these sovereign wealth funds have been set up and have grown so vast is that these are countries which are accumulating excess foreign exchange, which by definition they don't want to invest in their own country. They're building up these sovereign wealth funds because they're trying to keep down their exchange rates and they're neutralizing the capital inflows, the dollar inflows, by buying up the dollar assets. So I think the advantage that you have is that actually you're not, the private equity industry on balance is not really putting vast amounts of new capital at work because much of your investments are funded by local debt. You're putting in managerial skills at work. So if you, of course, ADIA might invest in China and the Chinese might invest in the Middle East and so on, but if you look at the emerging markets sort of netting out all the internal transactions, it looks like they're going to continue to have a lot of excess capital, which they want to invest in the dollar and euro area, and you will continue, I think, to benefit from that arbitrage.
I hope so. I mean, I'm not against that, but my point is, take Singapore, which has done a spectacular job of building up, in effect, 2 sovereign wealth funds, Temasek and GIC. It's a country with roughly 3 million people, so they couldn't possibly invest that money in that country. However, increasingly, I believe, they will invest more of their money in Asia, not necessarily in Singapore, and they'll do that through perhaps creating funds where they're the biggest investors that are based in those regions. But again, this may take a few years to happen.
Great. Well, I do want to give enough time to have some questions from the audience, so let me perhaps open it up to Q&A. I'd ask anyone who'd like to ask a question to raise their hand. We have microphones. We can begin right over there. And I'll ask everyone to please state their name and the organization that they represent before posing the question.
Morning, my name is Iñiga from the Spanish news agency EFE. The trade unions requested the day before yesterday for a regulation, a framework for the private equity sector. What do you think about it?
Would anyone care to comment? This was perhaps because you're based in the UK and closer to some of these markets, maybe.
Can you just repeat the question again?
I believe the question was that some of the trade unions had requested a private equity framework.
We're here in the economical meeting, and the day before yesterday they gave a press conference, and they were requesting the sector, the private equity sector, a political framework, a regulation from the political side in order, to protect jobs when these transactions take form. They were requesting more transparency, more information. Okay, you agree, you accept that you need to be more transparent. Do you think you need a political framework, a regulation?
Let me try to attempt an answer to that. In the UK, for example, the private equity industry is already governed by the FSA, and they look at us as an industry very carefully, so there is a bit of regulation there. And you may have heard of this process in the UK over the last 6 months of the so-called Walker Report, where the industry is trying to develop a voluntary code of behavior which they can communicate to the general public and adhere to in order to avoid any sort of movement towards a more stringent regulation of the industry. And we are regulated, the businesses we invest in are regulated, and I think it's much more a question of communicating what we actually do and communicating that the values, the governance that we follow are at least as good, and I emphasize at least as good, as the governance that people generally accept is good in public companies. And one of the reasons why our industry has had superior returns to public markets over many years is, I think, because we have had extremely good governance and great alignment of interests between shareholders and management in the past. So this Walker Report has set up a whole bunch of requirements for us to report with our privately held companies as if they were public, and the hope is from our industry that that will be accepted as sufficient transparency to reduce the worry and the skepticism and the fear surrounding what we do.
In some ways, the industry has created its own problem by its very name. We say it's private equity, but in many ways we're not private at all. The businesses that we buy often end up with far more disclosure in our hands than they had with their previous owners. As a simple example, when we bought the Hertz rent-a-car business from Ford, Ford really did not have to disclose very much about Hertz. Now that it's an independent company with publicly traded bonds, we have filing requirements. There are far more disclosures about the economics of Hertz than when it was owned by Ford. Similarly, as you just heard, we are heavily regulated, just as heavily regulated when we own the business than when Ford owned it, whether it's environmental protection, whether it's occupational safety and health, whether there's certain labor restrictions. Private equity still has to follow those same rules. The tax code applies in equal measure. So the notion that somehow these companies are spirited away and deeply held in a cave somewhere, I don't think is accurate. The industry hasn't done a good job in describing that, but perhaps one of the future pieces that's going to emerge by either a journalist or an academic is to show that the relative degree of transparency and regulation from public and regulatory bodies is really quite similar to a public company and a private company.
I was just going to add 2 points. One, labor unions are not going to fall in love with private equity, despite anything we might say this morning, or anything we probably do in a short period of time. Labor unions have, by and large, in the United States and some extent in Europe, have felt that private equity is a bit of an enemy, and we're not preserving jobs, or not enhancing jobs, and we're destroying jobs. Josh's study shows that's not really quite the case. But in the United States, the greatest job loss that occurs does not have anything to do with private equity. We've lost about 500,000 UAW jobs, or automobile worker jobs, over the last 20 years. Nothing to do with leverage buyouts. The steel worker industry, the steel industry, textile industry, we've lost hundreds of thousands of jobs there. Nothing to do with private equity. The job loss occurs generally and largely in large public companies, not with private equity related firms. Another irony that people might note is that even though there are labor unions and workers are often concerned about private equity, the truth is the biggest beneficiary of private equity has been the large public pension funds, typically in the United States, which are always designed to really, the money goes typically to workers, blue-collar workers, or other salaried workers. And so they have become the biggest investors in private equity and the biggest beneficiaries, but they don't probably realize how beneficial private equity has been in terms of increasing the value of their pensions. But the reality is that that's the case.
The only thing I would add on a more general note, thinking of unions particularly in Europe but also in America, the trade union movement, a lot of our political parties as well, are in a period of what you might call schizophrenia politically, in that a lot of these movements, a lot of these parties grew up, arose over the last 50, 100 years in opposition to the capitalist system, to put it very crudely. Over the last 20 years, basically since 1991, the capitalist system has clearly won as an economic model. Markets and competition are accepted as the only rational way of organizing economic life in all societies, regardless of their political structures, whether they're democracies or dictatorships. They've all become market economies. But ideologically, of course, there is still a lot of resistance to the social implications of capitalism. Now, 20 or 30 years ago, it was possible for parties, even democratic parties within broadly market economists, to be explicitly anti-capitalist and say that in the long run, our intention is to, in an extreme sense, overthrow the capitalist system and replace it with something quite different, call it socialism or social democracy and so on. Now that's no longer acceptable because, it clearly just doesn't have any traction. It's not rational. So nobody wants to overthrow the capitalist system as a whole, but there are plenty of people who are still uncomfortable with capitalism as an idea and are therefore always looking to pick off bits of the capitalist system for criticism, or to put it another way, more emotionally, there is always a need for scapegoats. And as long as the scapegoats are not too large in relation to the system and therefore don't really damage the stability of the system as a whole, that's one thing. And as long as you whip the scapegoats enough that they squeal a bit, but not so hard that you kill them, then you've got basically a winning formula, which is why I think we have had this, as already mentioned on this panel, we've had a series of scapegoats, kind of one after the other. First was the hedge funds, then it was private equity, now it's sovereign wealth. And I think this is something that is bound to continue because inequality, especially the extremes of inequality that we're seeing, which I think, frankly, are probably going to continue growing for the next few years, is a very uncomfortable social phenomenon. So it's not surprising that there should be a backlash towards it. And, you happen to have been the last scapegoat.
Well, actually, the last scapegoat is the media. The private equity people like to blame the media, say if only they would explain better what we're doing, the world would be better off. So we like to blame the media.
Just a quick comment on that. I mean, the general public has gotten very used to other sources of capital. You know, the family company was the original source of capital, and because that was not enough, the public markets were invented to raise capital. And I think what we're just seeing is that the public markets have, in certain circumstances, flaws, which now have to be filled by a third source of capital, which is private equity, either for companies that are not suited to be in the public markets, or companies which are undervalued in the public markets, where the potential lying in those companies is not seen. And those are the situations where private equity is used. And so if you just look at that, you know, it's just another source of capital, and over time I think will be recognized as such, and as over time it'll also keep on growing, because if you see a large public company, you can envision a world where this company will go back and forth between a state of being private and a state of being public, and it will go private when large discontinuities of value creation are possible. So when we as an industry perceive that it's undervalued, or that it could grow much better, or that it could be managed much better, or it could be governed much better, those are the situations we love, and that's where we'll move in. And typically these companies are better off in a private situation, because you'll have dropping earnings per share, you'll have management changes, you'll be selling and buying divisions, you'll be restructuring the balance sheet, and all of that can be done much better in a private environment, without the quarterly analyst reports, without the pressure on management to fulfill all sorts of compliance procedures rather than running the business. And then these companies will go public again after that value creation step has been fulfilled. And you know, companies don't grow linearly in terms of value creation. They grow in sort of waves, and many of those step changes will be done in a private environment and go public again.
Great. Let me turn to the floor again for a second question. Why don't we start right over there?
My name is Vali Musa. I'm chairman of Lareco Matia based in Johannesburg. We've just closed a fund last year to the value of, with commitments of 3.5 billion rands. I think you divide it by 6 or 7 to get dollars. I was interested in the discussion on emerging markets. This fund has over 90% of the commitments are from domestic money. In fact, what we found as we were raising capital for this fund was that it was much easier to raise money domestically than internationally, more hassle-free, and there was more money available to do that domestically, including from the Public Investment Commissioner, which is the closest to what you may call a sovereign fund as such. The question of the relationship with trade unions, we don't seem to have the same sort of problem that perhaps is being experienced elsewhere in the world, mainly because my view is that private equity funds in South Africa lead to job creation, that by and large their investments are linked to expansion in one way or another, whether it's take privates or whether it's investing in existing private companies, looking at opportunities for expansion both in South Africa and Southern Africa, but that may just be because we're in a particularly growth region of the world. Thanks. I just wanted to make that comment.
Can I just make one observation there? That I think what you're pointing out in your experience is sort of consistent with what we see generally. And I'm hesitant to use the word emerging, so I'm trying to think of a good alternative. But let's say the other non-traditional private equity markets are such that, you know, the need by and large for the sort of classic buyout with the sort of the heavy use of debt, the sort of squeezing of margins, you know, in many cases probably that degree of leverage would be difficult to obtain. But more generally, it's typically that's not where the greatest need is. It's for the situation where, for instance, one has the family business, which has been in the third generation, where they've done things great while it was a sort of local closed economy, and where today the markets are sort of opening up and there's sort of a need for much greater management and assistance. In some sense, there's a need for infusion of equity, but a lot of what the private equity group is doing is really helping the companies, positioning them to grow to the next level. And I think, you know, your experience there, I think, is very consistent with what we see in many of these other markets as well.
Good. Perhaps we could take another question right over here.
Weber, BBC News. One observation, one question. One observation is, one reason I think that private equity companies have difficulties getting their message across is because the wider public doesn't understand the concept of debt being possibly better than equity, because they're all told, don't go into debt, don't go, it's bad, it's really bad, and then these people are saying, oh, I've got a company, put lots of debt in, I'll make it better, and they don't get this. My question, though, is directly linked to that. Mr. Rubenstein, you already said leverage is not that much of an issue. To which extent are the current companies that are out there that are private equity owned and have quite a lot of debt on their books, to which extent do you think over the coming year or two will they be affected by the credit crunch as refinancing is necessary? Will there be any cash flow problems and then the need, say, to cut more jobs?
What I was saying before is that private equity firms can survive and do transactions that aren't dependent on leverage. We can take minority stakes in companies as well. But to answer your question, with the default rate for the last 5 years on leveraged buyout loans has been less than 0.5%, the lowest rate probably in 30 years for these type of loans. So we're not used to defaults as much as maybe people expected in leveraged buyouts, and that was in part because in the old days, the late 80s, the average equity component in a deal was maybe 5 to 7%, and the debt was 93 to 95%. Now the transactions tend to have 32 and 35% equity, and as a result, they're much better equitized. In addition, the debt terms of the last couple of years were so favorable to people like us that the ability to work through a problem is much greater because you're not as likely to run into covenant defaults or other kinds of constraints that make you go into bankruptcy. All that said, when economies go down, we're not magicians, and it's inevitable that there will be some companies that even with greater equity, even with greater covenant freedom, will have problems. And so I don't think we will continue to see a less than 1% or less than half of 1% default rate. I think we will have a somewhat greater default rate, but nothing nearly as high as we saw in the last couple of times when we had economic slowdowns and problems in the leveraged buyout business, that is to say in the late 80s or in the late 90s. I think the default rate will be relatively modest compared to what we've seen before. Still, if you talk to potential investors, the area that they are probably most interested in right now is distressed debt investing, so they probably know something about what's likely to happen.
We'll turn to another question right over here.
Yes, Ford Fraker. I'm the U.S. ambassador to Saudi Arabia, and I wanted to ask the panel their views on the development of private equity in the Middle East. Thank you.
Perhaps one of the practitioners would.
We do something. I'll give you my perspective on it. Historically, the Middle East, and by that let's call it the MENA region, which would be Northern Africa, Tunisia, Morocco, Algeria, Libya, Egypt, and the Levant area, Jordan and Lebanon, Turkey, the Gulf Cooperation Council countries, and then perhaps Pakistan. That area, the MENA region, was an area that people in the West went to largely to raise capital and not to invest capital. And as a result, you didn't see a lot of Western private equity money coming into the region. And the reason for that, in part, was the economies were not all that developed. Typically, when large infusions of oil money went into the region in the mid and late 70s and the mid and late 80s, the economies there couldn't deploy it or chose not to deploy it in the region, and they tended to recycle it in the United States and Europe. That has changed. After 9/11, a lot of people in the Middle East don't want to circulate or recycle that money to the United States as much as they did before, and even not as much to Europe. And so they're building economies in the Middle East that are far greater than anything anybody imagined even 5 years ago. Anybody that's been to Abu Dhabi or Dubai would know that firsthand. So because you have such large amounts of cash inflow, about 1.6 trillion into the MENA region over the last couple of years from oil wealth, these economies are now using a lot of that money in the region, and they're becoming very attractive places to invest. The investment opportunities are privatizations, minority stake transactions in public companies, minority stake or majority stake transactions in family-owned companies, and some classic buyouts that are being done. And I think you'll see much more activity in the region than you've ever seen before. Relative to Europe, United States, and Asia, the percentage of private equity capital available per as a function of GDP or a ratio of GDP is very, very small. And so there's great opportunities there. And my hope is that many of my competitors don't recognize that, but there are great opportunities there.
I'll turn to the floor. Right over there.
Bert Heemskerk, I'm chairman of Dutch bank Rabobank. Mr. Rubenstein, you just mentioned that the default rate of 1% wouldn't increase too high because of your experience over the last 5 years. But I think a 5 year period is not very relevant, I think, in industry. I'm now 38 years in banking, and I was raised at a time where financing holdings was not a business banks would do. And we are a big bank as well, so we are financing private equity investments as well. To make a comparison, a year ago we spoke about subprime delinquencies of 0%. Half a year ago we spoke about delinquencies in subprime of 5%. I made stress tests within our bank and I said assume 15%, and then they still said there are no losses. Today, as we all know, the delinquency rate in subprime is 20% or 25%. And in my view, your view that the delinquency or default rate will not rise above 1% or maybe 2%, I hope you are right, because we are involved in your business as well. I think the big difference between your business, private equity and hedge funds, is that you really look at the longer term. But I think the weaker point of private equity is the amount of leverage, the amount of leverage you use. And particularly, as you say yourselves, if the economy turns down and the leverage is high, because in most cases the companies you buy, you obviously fund it to a large extent with debt and so on. So equity is, in most cases, is 10%, 15% of a company, and in bad times that is too low. And that is one of the reasons why, you know as well, regulators are a bit skeptical about a too big increase of private equity. And I don't know whether you could comment on it, because I'm pretty sure that for the coming years, private equity, to the extent that it is highly leveraged, will be not a very healthy business.
I guess we won't be calling upon you for lending any money to any of our new transactions, but you make some very fair points, and I don't want to make it sound like I'm Pollyanna about the situation. What my point I was trying to make is that you really can't compare to subprime. Subprime was a misnomer. It had this wonderful sound, subprime. People thought it sounded good. It should have been called not credit-worthy loans. Had it been called not credit-worthy loans, because they default historically at 6 times the rate of prime loans, people in dentists and doctors in Germany wouldn't have been buying these things, and they didn't really understand the risks of subprime. Leveraged buyout loans don't default at 6 times the rate of non-leveraged loans to large corporations. They just haven't historically done that. However, if economies go into deep recessions, of course there will be stress in public companies and in private companies and everything. It's just that my view is that because the deals are better equitized than they were before, and the organizations that are working on these transactions are not the small organizations that we saw in the late 80s or 90s. KKR had probably 7 or 10 investment professionals when they did the RJR deal. Now I think they have 250, and other firms are very, very large. But a lot of these increases in the size of these private equity organizations are increases with operating managers who have a lot of skill in operating companies and improving them. And so I think they will not wait until the last second to try to fix these companies if they go into stress. But there's no doubt that the 0.5% default rate that we've seen in the last few years probably will go up, but I don't think it will go up so exponentially as to make people think that leveraged buyout lending is not a good business. I hope you won't come away with that conclusion, and I hope I'm more right than you are, but I'm sure the difference is probably somewhere in between. The reality is probably somewhere in between. It'll probably be higher than I would like, but lower than you think it might be.
Martin, did you want to perhaps comment just on the fundamental question whether there's too much leverage or whether there's exposure here that we're underappreciating?
I think it was said earlier, there's a huge difference between the leverage that was put on in 1988, 89, and today. And of course, we were all aware in the last couple of years that we were investing in very unusual debt markets, and that would come to an end. And so we, at least in the deals that we've been done, and I'm sure all of my colleagues have done the same, have run stress models on recession scenarios in all our leverage structures for a long time. And therefore, I think we're sort of fundamentally and structurally much better prepared for a potential recession than we were 10 years ago or 15 years ago.
Measuring that in terms of the capital structure, deals were done in the late 80s and a little bit in the early 90s before the market peaked, in which interest was really not even covered by the cash flow of the business. The emergence of a lot of zero coupon bonds and other financing instruments allowed people to buy businesses and pay so much with 10 or 15% equity that they couldn't even cover the current interest. The more typical transaction, which is just a translation of David's comment earlier of equitization of 30% or so, translates into even some of the most levered transactions covering interest 1.5 or 2 times. That buffer may not be enough for all companies, but it is substantially different than it was in the late 80s. Hence the expectation that default rates, although they may go up to historically, for high yield transactions, higher levels, which could translate into 5% at a peak, are not going to look anything like the subprime debacle.
Another factor that should be taken into account is when we had defaults in the late 80s or 90s, the firms that were doing these transactions were relatively modest, as I mentioned, in terms of personnel, but they also were modest in terms of their capital. Now the funds are so large that if more equity needs to be put in to shore up the balance sheet, they really do have the resources typically in their funds to put more equity into a transaction and to make it much more stable than it might otherwise be. So I don't think the default rate will be quite as high as we've seen before in other distressed periods of time in the buyout world.
We only have a few minutes left. We probably have time for either 1 or 2 more questions. There's one right over here if we can get a microphone.
My name is I'm from Biotechnology from Taiwan. We do microprocessor and communication chips. I got 2 questions here. One, David mentioned, for emerging countries or fast-growing countries to get into private equity is inevitable. So what kind of advice would you give to people interested to join this industry? And what kind of mistakes should they avoid? Second question is, private equity got pretty bad name. I think partly because it's mainly profit-driven. So any thought about, for all the panelists to make private equity firms better corporate citizens, bring more value to the communities? Thank you.
Well, why don't we start on the first question?
I think if I understood it right, the first question is what advice to give to somebody who's asking for private equity to invest in their firm. Was that correct?
To get into the industry.
To get into the industry.
Right, like for China, for all the other countries to become involved in this industry.
Right. Well, there's no doubt that in many of these countries, as was said earlier, new private equity firms are going to be formed. As also was described earlier, in China, there will be some huge private equity firms starting. And I think the basic advice is they need to buy in the experience that has been built in the West really over the last 30 years. And I think they will, and you can see the first signs of that where they're hiring experienced professionals, bring them in to start the business, because it is an experienced business. And we are all much better today than we were 20 years ago, and we've got lots of scars on our bodies to prove that there's a real learning process here, and there's no way to skip that learning and start from scratch. You really have to bring in the experience.
I think the good citizenship question is a good one. There's no definitive study, Josh, maybe you can work on that as well, of whether private equity firms are more involved in corporate responsibility initiatives than public companies. But I think most of our own experiences are that they are, or they should be. We don't perhaps publicize that enough. But it's for a simple reason. To have a thriving business that we're going to be able to build and over time create some value, we need committed employees, people and managers that want to work for that company, to have customers that identify very positively with that business. And the broader sense of corporate responsibility, whether it relates to going green and being sensitive to protecting natural resources, whether it relates to creating a package of benefits, including wages, but also other amenities for employees, are an essential part of building virtually every business that I think all private equity firms look at. So that is part of a broader economic equation, and my guess is when that study is done that the buyout firms will be viewed as, if not leading the charge, at least equal to some of the best corporate social responsibility firms in the world.
I think right now our large investors ask us for our rates of return, and then they look at them, and if they're attractive, they'll give us more money. If in the future they say, show me your rates of return, but also show me the taxes you've paid, the community organizations you supported, the way you've treated labor unions, and they have an index that measures more than just the rate of return, we will probably be fairly responsive. Right now, investors by and large don't judge us on that, but we probably will be judged on that in the future, and to the extent we are, I think probably our behavior will be modified a bit. Right now, virtually no investors ever ask me what type of community support we've given from our various companies in our portfolio. They just don't ask that, and therefore we tend not to keep that data very much. But I think if that changes, we will be responsive for sure.
And it's all, could I ask you if you think that's likely to change, or if that's a dynamic that would play out?
Well, I think, actually, as we've heard, if you look at the individual companies within some of these portfolios or the individuals who run private equity firms, you'd probably find that actually they were involved in a lot of corporate responsibility, a lot of philanthropic behavior and so on. And I've no idea, but my hunch is actually you'll probably find that there's more philanthropic money broadly going from private equity than there is from public equity, simply, to put it quite cynically and crudely, because there are a lot more rich, very rich people in the private equity business than there are in public equity. But I think what's interesting about this question and relates to the image of the industry, is there an argument perhaps for the industry as a whole to somehow consolidate some of this and say, as well as David Rubenstein doing something or Carlyle doing something, should there be some kind of private equity body which, as a body, doesn't necessarily give money, but undertakes some kind of corporate responsibility initiatives. And I think there's certainly precedent I'm aware of in London in the hedge fund industry. They've organized a number of foundations, one of which, best known in England, is called ARC, Absolute Return for Kids, and it's probably now the largest educational charity in Britain, where individuals in the hedge fund industry and companies are contributing to it, but it's to some extent presented as a hedge fund industry initiative rather than an individual one. And maybe this is something worth thinking about.
It exists. It's called the Private Equity Foundation. It exists in the UK.
And in the United States, the hedge fund people have done a very good job. They've created something called the Robin Hood Foundation, which is quite large. The private equity industry in the United States hasn't quite done something like that. And we've watched, probably with some jealousy, with the good publicity that the hedge fund people have gotten for the Robin Hood Foundation, and maybe something will be done by the private equity people in the future like that.
Well, look, I'm afraid, keeping an eye on the clock, that we're out of time. So I wanted to thank you for joining us, thank all of our distinguished panelists. And we'll look forward to continuing the conversation later this year or next year in Davos.